Hello, I'm Sinead McLaughlin and I'm on the line with Douglas Borthwick to discuss this week's market movers. Douglas, the ECB cut rates from 0.25% to 0.5%, making it less attractive for people to save, but more attractive to borrow or invest. What was your reaction to the cut?
Well, I think it was a surprise. Well, it definitely was a surprise to me. I think that already, though, an interest rate cut in Europe isn't really going to prompt anyone to do anything. I think what it does tell you, though, is that interest rates will stay low for quite some time in Europe, and I think the ECB really was, putting its stamp on that. Probably the most interesting thing now is if you look at the 2-year sector or the 10-year sector in the bond markets in Europe, they're all trading way below where the United States is. So right now in Portugal, we're trading at maybe 46 basis points for 2-year paper, whereas in the U.S. it's 50 basis points. So that tells you now that the carry trade is no longer in sort of borrowing in the U.S. or borrowing from Germany and buying into Portugal or buying into Spain or Italy. Now the carry trade is borrowing in Italy, Spain, Portugal, and buying in the United States. And that has tremendous effects for the euro in that if the carry trade now is to be short euros and long dollars because you're picking up at least 25, 50 basis points, then that's going to be the direction of the euro going forward.
Apart from this surprising cut, what else do you think had significant movement in the markets this week?
Well, I think the discussion of ABS purchases by the ECB is interesting. Probably the biggest hurdle, though, is that the ECB has very little experience in buying ABS back, and I think De Welt today had a very good article on that. But this is sort of it's the ECB moving into new territory. They're looking to move their balance sheet up to $1 trillion more than where they are right now, which is probably the most interesting part of the discussion yesterday. And what that means is going back to 2012 levels of where they were on their balance sheet. Now, when you have a large balance sheet and you increase it, what normally happens is you see equity prices rise and you see your currency fall. And I think that's sort of what we're seeing now. You saw the euro fall off, and you're going to see equity prices do quite well in Europe.
Now, of course, the US NFP figure has just been announced. Another surprise there. Economists estimated a rise of 230,000 jobs added to the economy, much more than the actual 142,000 rise. Some analysts are saying this is inconsistent with everything. What do you think?
Well, I think that jobs in general, the jobs number has been sort of overinflated in that what we're seeing is we're seeing jobs that pay a good amount of money in the workforce being replaced by jobs that pay very little or by part-time employment. What you have found, though, over the last 5 years is that the numbers for this month are normally revised higher by 70,000 on average. So if you do believe that this revision will also come as well here, then we're really sort of sitting there back around 219,000. So yes, it's a disappointing number. It'll probably give Yellen some pause, but I still think that the U.S. is in this mode of being more hawkish than dovish, and that turning point really came from the minutes that we last saw. And so I still believe that the U.S. will start raising rates. Maybe they'll put it off by a month, but they're certainly going to be raising rates while the ECB stays on pat.
And the Federal Reserve are going to be looking at this report the week after next. Do you think these results will give them more questions than answers?
Well, I think so, yeah. I mean, certainly December 2013 was the last time we saw such a small growth in the non-farm payrolls. And so it'll give them pause because I think that the Fed is sitting there and they have this belief that the economy is coming out of where it was, we're coming out of crisis, and that things are getting better. And you see numbers like this and it sort of puts the brakes on quickly. But I think the market will get over that very, very quickly. I think the Fed certainly wants to raise rates sooner rather than later. They want to get rates back to a normal situation. They want it to be sort of a two-way market as opposed to a one-way market. And the only way you can do that is by raising rates in the near term. So certainly they'll discuss it, but I don't think it's going to change the timetable.
And oddly enough, futures slightly rebounded immediately after the report, while yields, on the other hand, dropped right down. Bearing in mind that ECB surprise, how do you see the US dollar performing against the euro over the coming weeks?
Well, I think the US dollar, given you've seen a pivot in how the Fed thinks about the market, so the pivot being that the Fed is now more hawkish than dovish, so they've gone from very, very dovish to now more hawkish. So that's sort of dollar positive. And now given the ECB has obviously dropped rates, now is considering increasing their balance sheet up to the levels last seen in 2012, that's obviously going to be bearish for the euro. So in terms of the euro dollar, you're looking at going down to 2012 rates of where the euro was trading, and on an average it was trading around 128.60, but really it was in a 121 to 125 zone. So I think that the euro is going to be pressured down to the 125 level from the 129.70 level we're trading at today. Interestingly, today's NFP has done very, very little for the euro, And I think that we're going to continue to see this sort of move lower as asset managers in Europe reallocate their money from European fixed income and put it into US fixed income.
A lot of unexpected movements on the market this week. Thank you for your insight, Douglas. That's been Dukascopy's weekly wrap-up. Have a good weekend.